You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIWTweets.
Hello, welcome to The Investor Way with me, Sam Ball. It's the 31st of January 2026, and I'm joined today by my co-host, John McEwen. And on this week's episode, we'll be discussing Airtel Africa, Experian, Games Workshop, D Wetherspoon, Wolters Kluwer, and our US company of the week is Netflix. John, should I start us off with a favourite of the show and one we both own, Airtel Africa?
Yes. So, how were the results?
The results were very good. You wouldn't be able to tell that based on the share reaction, but I was very happy with the results. So, Airtel Africa, for anyone who's not listened to us before, when we've covered it, they are an African telecoms provider and they operate in, I think it's 13 or 14 African countries. And they're basically a telecoms provider in Africa, but they also have a part of the business called Airtel Money, which is kind of like a PayPal meets a traditional bank, which is also in Africa. So they have come out with their Q3 results for the 9-month period ended 31 December 2025. And they do report in dollars, by the way. So all these figures are in dollars. Revenue was up 28.3% to 4.667 billion. Operating profit was up 41.3% to 1.526 billion. And this is all for the 9-month period. EBITDA, that was up 31.4% to 2.283 billion, and the EBITDA margin was up from 46.2 to 48.9%. The net cash generated from operating activities was up 42.1% to 2.306 billion, and that's on revenue of 4.667 billion, so pretty much bang on 50%. Operating free cash flow, that was up 37.2% to 1.68 billion, and again on 4.667 billion of revenue, so a third, about a 33% margin. If we break the results down a bit further, and this is just looking at the quarter now rather than the 9-month period as a whole. So for the quarter, revenue was up 24.7%. And if we split it by segment, voice revenue was up 14.1%, data revenue was up 35.5%, and mobile money revenue was up 28%. Return on capital employed increased from 20.2 to 21.5%. Average revenue per user was up 12.8% to $3.2. Total customer base was up 10% to 179.4 million. Data customer base was up 14.6% to 81.8 million. Mobile money customer base was up 17.3% to 52 million. And in the operating highlights, they've highlighted that smartphone penetration rose another 3.9% to 48.1%. Airtel Money continues to scale with 2 major milestones reached this quarter. The first milestone saw the business exceed 50 million subscribers, reaching 52 million. Secondly, annualized total process value was up over the 200 billion threshold on an annualized basis, with an increase of 36% to over 210 billion. They've highlighted that the revenues of 4.667 billion increased by 24.6% in constant currency and 28.3% in reported currency, as currency appreciation supported the strong underlying fundamentals of the business. On CapEx, they've said, given the significant opportunity across our markets, we've accelerated our investment in line with revised CapEx guidance as previously communicated. CapEx of 603 million increased by 32.2% as we rolled out approximately 2,500 new sites, expanded the fibre network by 4,000 kilometres to over 81,500 to enhance both cover and capacity. Overall population coverage has reached 81.7%, an increase of 0.6% from a year ago. Leverage has improved from 2.4x to 1.9x, with lease-adjusted leverage improving from 1.1x to 0.7x, primarily driven by the improvement in EBITDA. They've said they remain on track to list Airtel Money in the first half of 2026. And interestingly, they actually have I wasn't aware of this, it's been going on for about a year, but they actually have a partnership with SpaceX to launch Starlink directly to sell connectivity. So on 16 December 2025, Airtel Africa announced its partnership with SpaceX to introduce Starlink direct-to-cell satellite connectivity across all 14 markets, serving those customers with compatible handsets. I don't know if that's going to make any significant difference, but I thought it was interesting. In terms of the valuation, it has shot up over the last year or so. PE is now at 35. However, the price to free cash flow is only at 8, but the price to free cash flow, that does rise and fall a lot with capital expenditure. And the dividend yield is at 1.54%. In terms of the share price reaction, the shares were down for the day. Well, initially, they were actually up 2% on these results, and then they finished the day down 6.6%. I can't see any reason for that, but they had run up so much and the valuation is a lot higher than when we bought it that, yeah, I can't see anything in the results that justifies the reaction, but it might just be that some people have maybe, well, I don't understand the share price reaction. I don't think the shares should be down 6% on these results, but equally, in the past 12 months, the shares are up 120%, so that might have something to do with it. So yeah, I was very happy with these results. I don't think there's really anything more I could have asked for. I think that every number was positive. John, as a fellow shareholder, what do you think?
Yeah, no, I was really happy with the results. I think, not all metrics, obviously revenue was up significantly, 28.3%. When you look at the sort of almost the old part of the business with voice, that was still up 14%, data 35% and money 28%, and the user base for the money up 17%. And it's got a very impressive return on capital employed metric as well. So I thought this was really, really positive. In terms of the share price reaction, you do wonder whether people are just taking profits now. One of the key things here is going to be how that mobile money sector of the business is valued when it's spun out, in this half, basically. And depending on that, but the valuation, as you say, is much, much higher than it was when we bought in. And I suppose the expectations accordingly are much higher. But I think it's a great business. I'm very happy holding on to it and excited to see how we go with the mobile money spin out.
Should we move on to another great business?
Yeah, no, absolutely. So it's one that neither of us own. I had actually been close to buying shares. It might be getting on for 10 years ago, actually. So that's Experian. It's one of the world's largest credit rating agencies, and it is the UK's largest. They had their Q3 statement out last week, with Experian reporting third quarter organic revenue growth of 8% against 7.7% expected, excluding currency impacts. And growth was driven by North America through all regions, and channels contributed positively. Following the raise back in November, full-year guidance was left unchanged. Revenue growth is expected at 11%, and 8% of that organic, and margins are on track to improve by 0.3 to 0.5 percentage points. The shares were down nearly 4.5% in early trading. In terms of valuation, Experian has a market cap of £25 billion and trades at 22 times forward earnings, compared to the 10-year average of nearly 26, and it has a prospective dividend yield of 1.7%. I thought this was a decent trading statement. I'm not sure why the market was disappointed. I think, Experian is a top quality data company for credit reporting and more broadly data analytics, identity verification. It's one of the big three in the US, which is essentially connecting borrowers with lenders. And there are growth opportunities ahead, both in the developed markets, but also in the emerging markets, and particularly Latin America, where they've got a presence. I think there is an ongoing debate about how AI might be utilised in businesses like Experian with the vast data sets it has. But it also seems to be partly a worry for investors with some data-rich businesses like Experian, Rightmove, Autotrade, other ones we've covered, and whether AI sort of maybe threatens them. I think people also question how some of the cash might be used if they are investing in AI. And I guess Rightmove is one of the big examples in the last sort of 6 months where they were slated for their I think it was about £1 billion that they'd allocated specifically to AI investment. And, that obviously hitting the profits. I think a point that Nick Train has made recently is that we have quite a lot of high quality businesses in the UK, and in America, we often praise them for investing the capital wisely, growing the business, and perhaps not paying out as many dividends as a result. But then when we do have some of these higher quality businesses in the UK, and they do decide to, invest in themselves rather than paying it out as profits, sometimes, the market is a bit more critical of that. But ultimately, if it's going to grow and enhance the business, then we probably should be, more encouraging of that. But overall, I thought this was a good trading statement. I think it's an incredibly high quality business with really valuable data. Yes, it's not cheap to buy, but I guess it's been a bit cheaper than it has been for a number of years now. So perhaps on that basis, it is quite attractive at the moment. I think I'm anchored to when I first looked at it, which was probably 15 to 17 pounds a share. So, but I do need to look past that and think a bit more objectively about it. But that's where I am at the moment.
Yeah, I agree. I don't think there's really anything in that statement that suggests the shares should have dropped 4%. Maybe the market was expecting another raise on guidance. But yeah, it's really, really solid.
Yeah.
Revenue growth of 11%, including 8% organic. I think for a business of this size and quality, I think that's really, really good. I think to get it at a forward P of 22, I think it's more attractive than we've seen it in a few years. But I think if you were to look at other businesses that have maybe been hit by the same issues where it's fears of AI, so like Rightmove and Baltic, both of them at the minute, I think you can get at a PE below 20. So I think in terms of the opportunity cost, it's probably not quite there yet, but really, really high quality business. Again, you look at the share price, it's just back to where it was a couple of years ago. But the thing is, for those last couple of years, it has been expensive. So it's a business I'd be interested in at the right price because it is really high quality. And I don't think there's actually much of a reason for this drop. But all I'd say this drop has done is maybe taken it to a more sort of reasonable valuation.
Yeah.
So it's probably not at the point where I'd be looking at it seriously yet.
And what are your thoughts on AI and some of those data-rich businesses, Rightmove being one example?
My instinct would probably be more based on historical trends in sort of stock market and how the market has sort of priced stuff in for certain sectors and new sectors and stuff. Like 3D printing is a good example. Voice search is probably another one. Driverless cars, where you get these things and then it maybe takes a lot longer for them to become sort of totally normal than you'd think. I think it's definitely going to be a big thing. How far away are we from an AI that basically can just make Rightmove's business totally redundant? I just think we must be miles and miles away from that. I don't know, because I probably don't understand AI well enough to actually maybe visualize some of the stuff it's going to do. But if I think of the way I'm using AI at present, being in the middle of the process of buying a house, like looking for that house, if I had to, get rid of one of AI or Rightmove for that process, I'd have got rid of the AI because it was useful for, questions about the process and stuff. But in terms of finding properties, I mean, Rightmove's still where all my minutes were spent.
Yeah.
I think it would be the same with Baltic. And I think to actually get to a point where AI can, seriously disrupt these businesses, I just think we're miles and miles away from it. I don't know. What do you think?
Yeah, that's my instinct. But I suppose when you actually own the shares, you are a little bit more jittery about it. And I suppose it is, having confidence in that belief and that thesis. But there are certainly, things where you're a little bit more anxious. But that would be my instinct, as you just outlined. And I suppose that's one of the reasons I'm still holding on to the shares, because that is what I believe deep down.
I think as well, it's probably from the perspective of I use AI every day. It's replaced Google search for a lot of my questions.
Yeah,
I use it at work to help sort of draft emails and stuff and sort of some of the technical research. It's really, really useful. So it's not like I'm totally ignorant on it. Usually, if I can find a use for AI that's going to save my time, I will give it a good go. There's loads of stuff you can use it for, but it's not a point where I think I could use it in a way where it would actually disrupt some of these businesses.
Yeah.
So yeah, I think it's overblown, but we will see. But yeah. I just think, we've got some really high quality businesses here. And you've probably you are maybe getting a chance to buy them at prices that we probably haven't seen for at least 5 years.
Yeah, and I suppose the other question is, and I guess Rightmove would come into this, is how they can invest in using AI and whether that can enhance their own profitability and their own product.
Yeah, I'm probably skeptical on that side as well, because I just think the amount you'd have to invest to create a really good kind of AI system, So, for example, like with, Relics, when we've covered that,
Yeah.
one of their products at my previous place where I worked, they had like, it was a Tolly's one, and they had an AI product, and we got a trial of it and used it for a couple of weeks. And the results it was giving in terms of the answers and stuff, it wasn't that much different to like Perplexity or like Gemini would have given. It was a bit better because it was using their database only. So what it was doing was filtering out a lot of bad information sources because they just weren't being used.
Yeah.
But even then, I wouldn't say it wasn't that much more accurate that we got the paid version. We were just like, well, as long as you know what you're doing and you can kind of tell what you know enough to figure out when it's right and when it's wrong.
Yeah.
You can use the free ones. And I think what we're going to have is a lot of companies maybe trying to invest in these more bespoke AIs when actually it's going to be the Googles of this world where they're going to have a more general one like Google search. And people are just going to end up piggybacking off that. That's what I think will happen. I think you're just going to end up with sort of a couple of really dominant ones. You're not going to have all these I kind of view it as like some kind of, if you want some kind of niche search engine. In reality, it's like people still just use Google for everything. So I think some of the investment, I'm skeptical about the results of what that's going to generate on the other side of it.
Yeah. And I suppose that's the story with Rightmove when it's been around £1 billion, which is for a company of that size, pretty big. So, and
I think they're going to end up sort of piggybacking off these bigger, more general ones and coming up with some kind of partnership deal or something like that with like Google or something. I think that's where it's going to go, where the actual underlying AI hasn't been produced by them and they're maybe just tailoring it to sort of their data or whatever. I think that's probably seems more realistic. What about you?
No, I would agree. I mean, I'd like to think as a Rightmove shareholder that it was a wise investment for the £1 billion, but time will tell.
Yeah. Right. What do we have next?
We have Games Workshop, Sam. So another favourite, and sadly one that I don't own.
Yeah, so this one, the results are actually a couple of weeks old, but I must have missed them, so we're going back to them. But Games Workshop, I'm sure it needs no introduction. They make the Warhammer figures. They have come out with their half-year results, and total revenue was up 10.9% for the 26 weeks ended 30 November 2025 to 332.1 million. And that was split between core revenue of 316 million, which was up 17%, and licensing revenue of 16 million, and that was down 47%. Operating profit, that was up 11.3% to 140 million. And that gives it an operating profit margin of 42.3%, which I think is excellent for what they're doing. Earnings per share was up 10.7% to 319.9p a share. And dividends were up 21.6p a share to 225p. If we look at the revenue by segments, so retail and online, they were up reasonable amounts, but most of the revenue increases come from the trade sales. They were up 25.2%. And in the summary from the management, I'll just read out the bits that are most interesting. We've delivered profitable sales growth in all of our core 23 countries and all our 3 channels. We continue to expand our own stores geographically, slightly slower than we had planned, but I'm sure we will catch up. And our dedicated export team delivered product range support to our distributors in 58 export countries. All but a few continue to deliver like-for-like sales growth year after year. We reported in the 2025 annual report that new tariffs could impact profit before tax by about 12 million in this year. We've incurred approximately 6 million in the period as a direct consequence of US tariff charges. The impact on our gross margin has been more than offset by efficiencies, price rises of approximately 3.5% on our miniatures and books, more stable commodity prices, and lower stock write-offs. Our work is not done. This will remain a key area of focus. We had great fun signing off on a new capital project to open a Warhammer World format location in North America. We cannot wait to see it open in 2027. Our live action endeavour is still in development with our partners, Amazon MGM Studios, Henry Cavill and Vertigo. It is the nature of these things to take several years, and while we wish we could tie down a release the way we can with our core business, the reality is, as with any licensing deal, delivery is not in our control. We leave it to our partners to manage their own businesses. In the meantime, work is almost complete on a standalone Warhammer Age of Sigmar episode, again for Prime Video. If we look at the results in terms of the store numbers are at 575, and that compares to 570 in June 25. So UK is flat at 134 stores. North America's up very slightly from 201 to 202 stores. Continental Europe, that's up from 167 to 170 stores. Australia and New Zealand, that's down from 48 to 46 stores, and Asia is up from 20 to 23 stores. They've said retail sales in North America are up 2.9% to record levels at 24.9 million. In the UK, retail is up 2.3% to record levels at 18 million. So North America is a bigger business than the UK business. This includes sales from our Warhammer World store located at our HQ. Retail sales in continental Europe are up 16.2% to record levels too at 15.1 million. Retail sales in Australia and New Zealand are down 9.8% to 3.7 million. Our new country manager has some work to do, and I know he's up for the challenge. In Asia, Japan retail sales are up 25% to 2 million. Our 2 stores in Singapore and Malaysia have performed okay, still room for improvement. Our 3 stores in China performed much better. In terms of the valuation, the business trades at a PE of 31.36 and has a dividend yield of 2.46%. I'm pretty happy with these results. I think there's nothing to write home about. The store openings was a bit disappointing, but they have said they expect that to increase again. And I still don't really have any doubts about the potential for more stores. The licensing revenue decreasing, I'm not as bothered about, just because that is by nature going to be very lumpy. The main thing in terms of the licensing is that Amazon TV show, which is still in the works, and that's a couple of years away probably by the sounds of it. So I think really it's just a case of wait and see until that comes out. But I think in terms of the way they're operating the business, very, very happy with it. I like the way management thinks. I like the way they're approaching things. And I think there's lots to be excited about, whether it's the potential for more store openings, that licensing revenue, the Amazon deal, the Warhammer World in North America. Yeah, I think at 31 times earnings, it's not a cheap business. But when you look at that American business compared to the UK, it's bigger, but it's not loads bigger. And I think America could be a much, much bigger market than the UK. I think they've still got loads of room for international expansion. So yeah, a P of 31, whilst it's expensive, very happy to continue holding it. What about you, John?
Yeah, I mean, I'm always full of regret with with Games Workshop, because I think you picked up fairly early when we covered it that this is an incredibly high quality growth business, and you bought shares in it. I don't know, looking back, whether it was partly the valuation at the time. Maybe I didn't I didn't have the conviction that you had in it. And it's really that growth has kicked on. It's an excellent operator and has such valuable IP. And it seems to be one of those very few UK businesses that looks like it's going to crack America, but is still very early on. I suppose that's how you get to the current valuation. And then I guess I'm again anchored to the price of a few years ago, and also a bit wary to pay up for 31 times forward earnings. However, it does feel like if it can, and it seems to be ready to crack America, then that comes down very quickly, given the size of the current presence it has in the States. So yeah, I don't know. I'm probably still on the fence, which is not a helpful place to be. I suppose I need to just look at it objectively today rather than how it has been. Although looking at it operationally, it does give you confidence going forward. So yeah, I'm probably not brave enough. But when did you actually buy shares, Sam? When exactly was it?
I've had it for a few years now. I think when I initially bought it, I think I bought an initial tranche somewhere between £100 and £120 a share.
Yeah.
And then it had a drop a few years ago. Just check, have a look at the graph. Yeah, it did actually. Yeah, so I must have bought it. I must be getting on for 4 or 5 years now. But yeah, if you look at it on the 5-year graph, it was around sort of 5 years ago, 100 to 120. So that's when I initially bought. And then there was that drop to sort of £60 a share. I topped up quite heavily then. So I think my average is kind of probably around, I want to say about £80 a share. I think That's my average buy-in cost. And then it's now at 170.
Yeah.
I don't think in the time we've really covered it, it's ever really dropped below kind of 25 times earnings.
Yeah.
It's always been pricey.
Yeah.
For
good reason.
Yeah, it's always delivered as well. That's the thing with it.
Yeah, no, fair enough. Shall we move on to a less growthy business?
Yes, how are Wetherspoons doing?
So, not too badly, actually. So, Wetherspoons, I mean, we've covered it lots of times on the show, UK's largest pub chain. They had a trading statement out for the second quarter with like-for-like sales growth increasing to 6.1% for the second quarter, and that was supported by growth of 8.8% in the 3 weeks around Christmas. However, with costs higher than anticipated, management now expects profits to fall in the first half. Full-year profits are also expected to fall slightly if sales momentum remains unchanged, and the shares were down nearly 6% on the statement. In terms of valuation, the group has a market cap of £706 million and trades at 13 times forward earnings, compared with a 10-year average of 19.8, and they have a prospective dividend yield of 1.6%. I mean, I think the sales growth of 6.1% is encouraging, but as might be expected, in a very tough industry and on the back of the last 2 budgets, the increase in costs, and they are really biting, with an extra £45 billion in the first half alone. It's tough. And I think Wetherspoon's best operator in the pub sector, if they're struggling, it does tell you something. Other things that are encouraging and I suppose tailwinds for the business, you've got the World Cup this summer, but I see little otherwise to be positive around. I think the group are trying to pivot a bit more to being more family orientated, serving more food. You've got the problem with Gen Z drinking less, and I guess, as a pub business, well, how do you handle that? I suppose a lot of places have gone more sort of gastropubby. They have more food, so it become a destination in that kind of sense. You see that to some degree with what Wetherspoons are trying to do, albeit less in terms of sort of higher end gastropub, but more in terms of the food business and getting people through the door. That's something that they've always done. And, going back sort of 20 years ago, they started doing things like breakfasts. And, traditionally with a pub, people would go in more in the afternoon, in the evening to have literally an alcoholic drink. Tim Martin, as shrewd as he is, thought, well, we've got the same operating cost. It won't cost us much more to open in the morning and to be serving things like, coffees, breakfasts, etc. So he does innovate in that kind of sense, but I suppose that can only go on so far. Other things, as well as the budget, obviously you've got increased employment rights, and in the sort of, I guess, short-term nature of the Wetherspoons job and people who might occupy it, you wonder whether that's going to cause them a bit of a headache as well, quite apart from just the costs that they're facing, business rates, minimum wage going up, and national insurance. Other things, I suppose one thing that people and investors have talked about for a long time is the book value of the business as part of the investment case, whether that's just in terms of downside protection, because really it doesn't look like it's a business that's going anywhere. It's just kind of trudging along from tax hike to tax hike. But if you looked back at the property valuation of the Wetherspoons estate, and this is going back 25 years the last time it was valued at £1.1 billion then, not revalued since. And the market cap for Wetherspoons is 706 million. So I guess it depends what you think that is worth, but whether that's ever realistically going to be realised. And for me, it doesn't add much to the investment case. I'd rather buy a business that is growing and growing well without having to think about, well, if we were to break the group up, what would it be? What would it actually be worth? So that doesn't really sort of draw me in. And I think it's just, coming back to the original thing, such a difficult sector. I like Tim Martin, but I couldn't buy shares in Wetherspoons.
Yeah, I agree. I feel really sorry for them, to be honest. I think in terms of this trading statement, I think revenue's up by a good amount, but the costs, they're just being absolutely hammered on it. There's not really a lot they can do. There's so many different things you can point to in terms of headwinds in what is already an unbelievably tough industry. I wouldn't really take much account of the book of the value of the properties, because I just think, like you've said, how likely are they to get realised? It's just so unlikely that value is realised. in at least the short to medium term that I just wouldn't factor it in. I think you have to do it based on the earnings potential of the business. And yeah, I just think for the amount they've got going against them, that PE ratio, actually, I think at 13 times earnings, I think, and such a low dividend yield, I think why would you even look at it? So yeah, but it's not their fault. They are just in such a tough. The only thing they could really do is pivot to a different industry.
Fine. Shall we move on to a debut on the show?
Yes, Wolters Kluwer. So, business I wanted to cover for a while but never got around to. So, it's a Dutch business and they provide basically software. So, a leading provider of information software and services for professionals. They serve customers in more than 180 countries, operate through 5 divisions: health, tax and accounting, financial and corporate compliance, legal and regulatory, and corporate performance and ESG. So they're very, very similar to RELX, which we've covered before, in terms of that information that they're providing for professional services. On my side, what I'm most familiar with is one of my previous employers. They use the software CCH, which is very, very popular for like small and medium-sized accountancy businesses. It's one of the most dominant softwares. That's owned by Wolters Kluwer. So they actually don't have any results. So their full year results come out next month. However, they did back in November come out with a 9-month trading update. So just because I wanted to look at the business, we're going to go through that instead. Yeah, so for the 9 months to 30 September, they've said in constant currencies, revenues increased 7%, including net effect of acquisitions and divestments. Recurring revenue, which makes up 84% of the total, sustained 7% organic growth, and that's in line with last year, while non-recurring revenues declined 2% compared to 2% growth last year. Within recurring revenues, cloud software revenues grew 15% organically compared to 16% last year. The 2% decline in non-recurring revenues, which make up 16% of the total, was mainly caused by expected declines in print books, professional services, and on-premise software licenses, combined with slower growth in transactional revenue. Revenues from North America, which make up 63% of the total, grew 5% organically. That compares to 6% a year ago, while revenues from Europe, which make up 29% of the total, grew 6% compared to 5% a year ago. Asia Pacific and rest of the world make up 8% of the total. They grew 6% organically compared to 7% a year ago. 9-month adjusted operating profit increased 15% in constant currencies. For the health division, organic growth was 5% compared to 6% a year ago, after momentum picked up in the third quarter for both clinical solutions and learning, research and practice. Excluding print, organic growth was 6% compared to 7% a year ago. Clinical Solutions delivered 7% organic growth compared to 8% a year ago, reflecting good renewals for up-to-date clinical decision support and successful cross-selling of our drug data solutions. I don't suppose you've heard of up-to-date, have you?
I have actually. A hospital that I worked at in the past did have a subscription to that. So yeah, it's good. It's a really good resource actually.
Oh, right. There you go. That's 2 of them that we're familiar with, so that's quite good. If we move on to tax and accounting, organic revenue growth was 7%. That was in line with last year, following a pickup in the third quarter compared to the first half. Recurring cloud software revenues recorded double-digit organic growth in North America and Europe. Tax and accounting North America delivered 7% organic growth, with strong double-digit organic growth in the cloud-native software suite, CCH Access. Tax and accounting Europe sustained 7% organic growth, which was in line with last year, with solid performance across all regions. Financial and corporate compliance division. Organic growth was 4%, and that was down from 5% a year ago. Recurring revenues, which make up 68% of the division total, were 6% organic growth, and that's in line with last year. And to break that down a bit more, legal services grew 6% organically, and financial services were up 1% organically. For the legal and regulatory division, organic growth was 6% compared to 5% a year ago. And for the corporate performance and ESG division, organic growth was up 8% compared to 9% a year ago. Recurring revenues, which make up 75% of the total, grew 13%, driven by cloud software revenues, which grew 17% organically compared to 20% a year ago. They've highlighted that the 9-month adjusted free cash flow was up 17% in constant currencies. Cash conversion benefited from favourable timing of working capital movements. Net debt to EBITDA ratio was 2.2x as of September 2025, and they completed a 1 billion share buyback on November 3rd, 2025. And for context, that's on a market cap of 18.4 billion. So decent amount. It's a few percent. That is more than that, isn't it? It's more over 4%. So that's pretty good. And they've got a new mandate signed to repurchase shares for up to 200 million from November 2025 up to February 23rd, 2026 as part of the 2026 share buyback. Probably worth covering the share performance first. So it's not done very well. it's basically down over 50% compared to where it was 12 months ago. Its 12-month high is 181 euros, and it's currently at 79 euros, which is basically a 12-month low. I had a look because I think this trading statement is pretty good. I know it's slightly down on where it was last year, but it's not a huge difference. It's clearly a very, very high quality business in line with sort of Relux. Well, very, very similar to Relux, actually. Really, really high quality. One of the issues we've had with Relux has always been the price because there's no issues on the business side. But this has taken an absolute battering in the last year. I've had a look. I can't find anything explaining why. And sort of commentary and articles basically suggest that it's because of concerns that the business could be disrupted by AI. It's a bit of a theme of this week's show, actually.
Yeah.
That's why it's down over 50% in 12 months. My experience, having used CCH, I think of the 3 employers I've had, CCH, that's probably the best practice management software that I've used. Very, very well respected within the industry. It's not going away. You've got a lot of transition to cloud, but it seems like the cloud growth rates are pretty good anyway. So yeah, I don't think any concerns on that side. Obviously, I know you spoke very briefly about it, but it seems like on the clinical side, that seems like a pretty good software. I struggle to see this being seriously disrupted in the short or medium term. So in terms of the valuation, it now trades at a PE of 16.5 and has a dividend yield of just over 3%. I think this looks really, really interesting. I think it's a really, really attractive valuation for a very high quality business. I think those numbers are all good. The organic growth rate is sort of high single digits. It's kind of what you expect for for a business of that size. I think it can keep doing that for a long time. The businesses are very, very sticky. Moving over from one practice management software to another is an absolute nightmare. So yeah, really, really well positioned for future growth. They've got the transition to cloud. I do not see AI disrupting this anytime soon. So I think at 16.5, I think because we've only covered it the once, I'm not going to go out and buy it. But I'd be very, very keen to go and look at these results in a month's time when full year results are out and see how it's doing. And hopefully it's still at a similar valuation. What do you think, John?
Yeah, it's interesting because I think when I think about UpToDate in particular, I do think that is actually ready for sort of AI disruption in the sense that I think a lot of people would use it as kind of a reference tool. They'd look up articles, look up evidence, the latest data on things. I think with things like ChatGPT, I think professionals could increasingly, if they know what they're looking for and they want to find the latest trials, the latest studies, and particularly if they want, even if it's just to reference that said article or summarize it, I think that's where OpenAI in the form of ChatGPT would actually disrupt it. Because I think UpToDate, from what I remember, and this was sort of 5-6 years ago, it was quite a nice product to use. And there are a number of almost search engines to look up the sort of things you would look up on UpToDate. But I think OpenAI does really make that even more accessible. And I think if you look at a subscription for example, ChatGPT or what's the one you use, Sam? Perplexity. They are a lot cheaper than UpToDate. So that's where I would have some concerns, and I don't think that UpToDate is as sticky as perhaps the accounting side of the business. So I'm not. I'd be probably a bit more wary overall.
Ooh, that's very interesting.
Yeah.
On the accounting side, that's just not my experience. But yeah, I see where you're coming from. But yeah, I'd be keen to come back in sort of a month or so when the full year results are out and see if there's any more detail in there. But yeah. I suppose as well when we cover it next time, we can maybe dig more into sort of what proportion of revenues are coming from which area.
Yeah,
that's probably the other thing to look at. Because if UpToDate is not a huge part of the business, that maybe changes it. But yeah, if it's sort of 20-30% or something like that.
Right.
But yeah.
And sort of anecdotally, on the ground in the UK, it feels like, because I've only used AI probably the last year, if that. So I don't know whether that's a late or an early adopter, but increasingly just, friends, colleagues using it more and more. And if that is the picture nationally, globally, then you'd expect to see some change, for example, with UpToDate pretty quickly, I would have said.
Right. Okay. So we won't have to wait long.
Well, my take on it, anyway, for what that's worth. Right, so shall we go on to our final company of the week and US company of the week?
Yes, how are Netflix doing?
Very well, in short. So they had their Q4 results out with revenue growth of 18% against the 17% expected, driven by membership growth, price hikes, and increased ad revenue. Operating profit rose 30% to $3 billion, with margins up from 22.2% to 24.5%, and both came in ahead of expectations, driven by the top line growth. Free cash flow rose 36% to $1.9 billion, and net debt was at $5.4 billion at the end of the period. And we'll come on to it, but that may well change soon. For 2026, first quarter revenue growth is expected to be 15% against 16% expected, with operating margins improving by 0.4 percentage points against the 2.6 expected. And for the full year, revenue growth of between 12 and 14% was broadly as expected, but margin guidance of around 31.5% was lower. Netflix has amended its Warner Brothers offer to all cash and will be suspending share buybacks to help fund the acquisition. And the shares were down nearly 5.5% in pre-market trading. In terms of valuation, Netflix has a market cap of $357 billion and trades at 26.5 times forward earnings, compared with a 10-year average of 67. I thought these were excellent results, and there has been a massive re-rating in the share price over the past few years since we started covering it. Almost can't believe how cheap it did get. I appreciate it was having some difficulties a few years ago, and we were pretty bearish. But with the HBO Max and Warner Brothers potential acquisition, I think that would be massive, and it would make their portfolio such high quality, sort of on par with Disney, with the intellectual property that they would own. It is, and I think this is, you see it in the numbers. If they're going to go all cash, it's going to be a significant amount of debt that they're taking on. They're talking about it being in excess of $50 billion. And at the moment, net debt is just 5.4. So they are taking a significant amount of debt on there. I think it will be a better business with Warner Brothers and HBO integrated. And I think if I were a shareholder, I would be hoping that they would be able to do that. Obviously not paying over the odds for it. But then I think the quality of Netflix would be even higher. And as a Disney shareholder, well, I've been disappointed with Disney, particularly over the last couple of years, and the turnaround that's never really taken place. And I think Netflix is serious competitor, and it would be a much better business. I mean, it is already a better business than it was, and much more resilient. So, yeah, I think on all fronts, Netflix, great operator, and I think it'll be even stronger if that acquisition does go through, which is far from certain at the moment. I know Paramount have been interested as well and made an offer. So we will see what happens there. I don't think at 26.5 times forward earnings, it's outrageous either. Although, again, anchoring coming in now that we've been going for 5 years and covering some of these businesses, how cheaply you could have had Netflix going back probably 2022. Sam, what are your thoughts?
Yeah, I think really good set of results, really good business. We talked about the Warner Brothers deal a couple of months ago, I think a month or two ago. And yeah, that just makes it so much stronger. I think I know they take on a lot of debt, but I think it's absolutely worth it for that quality of IP, because they don't, if you compare that to maybe say like when Disney bought 21st Century Fox, which they're still suffering from as a result of the debt, and they've still not paid it off. Arguably, Disney had less need for the 21st Century Fox IP. Whereas I think if you look at the Netflix brands, they don't really have much that's of a similar quality to the stuff Warner Brothers has. And we went through it last time we covered it. But I think it's almost worth paying any price for, really. So yeah, I think that debt's worth taking on. I think it gives Disney a serious problem. I mean, don't know. I don't think I'd buy it at this valuation. I think the time to buy it would have been 2 or 3 years ago when we were criticising it. But yeah, I just never would have anticipated the turnaround. It was just such a temporary wobble in terms of the subscriber numbers and the way it's kicked on since. And then you add in this deal. Yeah, if I was a shareholder, I definitely wouldn't be selling.
Yeah. Okay, so of the companies this week, what would be your top pick and what would be last?
So I think last is easy. It would be Wetherspoons. Not really through any fault of their own. It's just such a tough industry, and I think that's shown in that trading statement. Top, it's tough because we've got some really, really high quality businesses, but the issue they've all got is that none of them are cheap. Apart from Wolters Kluwer, which you've maybe sort of expressed concerns as to why it actually might be more justified, the revaluation for that one. I think I'd probably go with Games Workshop. I think that would beat Airtel Africa for me, but it's really just on valuation. I think Airtel Africa are really, really happy with those results. Very excited for the Airtel Money spin-off, but Games Workshop's just a little bit cheaper, and I think it's much easier to see where that international growth is coming from. I feel like Games Workshop is just inherently lower risk than Airtel Africa, so I think I'd go Games Workshop. What about you?
Yeah, I mean, without sounding boring, it would be, well, D Wetherspoons is an easy last. I own Airtel Africa and I'm very happy with it. Would I go out and buy it at the current valuation, even though I think there's a lot of upside? It would be that sort of, the inherent risk in it. I think even though it's expensive, I think Games Workshop, as you say, is a safer bet and a lot of upside. But even then, it's coming to terms with that valuation. I think Experian, I suppose that's maybe where Experian comes through the middle, is quality business and it's not as expensive. I'll go Games Workshop.
Okay. I think that's everything in that case.
Thank you very much for listening, and we will see you again next week.
See you next week.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter at TIWTweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.